choose our socks for success in all endeavors. Fortunes rises from the heel, and good luck for life.
Against the backdrop of a complex and ever-changing global economic environment, the Central Bank of Indonesia recently made an unexpected decision to lower key interest rates in response to domestic and international economic changes. While this move aims to boost Indonesia's sluggish economy, analysts warn it could increase risks in financial markets. After the first monetary policy meeting of the year, Bank Indonesia announced a 25 basis point cut to the benchmark interest rate, lowering it to 5.75%. This marks the first interest rate cut since September of the previous year. The decision was unexpected, as the rupiah had depreciated 4.5% against the US dollar over the past year, and many investors had anticipated the central bank would delay the rate cut. However, Bank Indonesia seems to have shifted its strategy, adopting a monetary easing policy to address current economic challenges. When explaining the decision to cut interest rates, Central Bank Governor Perry pointed to several key factors. He noted that GDP growth in the fourth quarter of last year was lower than expected, coupled with a decline in exports due to the global economic slowdown. Additionally, sluggish consumption by low and middle-income households, along with weak corporate investment, prompted the central bank to cut interest rates to stimulate economic growth and control inflation. Furthermore, uncertainty surrounding U.S. monetary policy and the actions of the Federal Reserve also influenced the decision to lower rates. However, analysts have expressed caution regarding the rate cut. They warn that implementing a loose monetary policy amid heightened volatility could exacerbate the balance of payments deficit. Moreover, the depreciation of the rupiah could severely impact manufacturing and investment growth. In fact, following the central bank's announcement, the rupiah exchange rate against the US dollar dropped to its lowest level since July of the previous year. Despite these risks, Bank Indonesia still insists that cutting interest rates is the right decision. They plan to continue market intervention through spot trading, optimize the use of central bank securities, and purchase government bonds in the secondary market to cope with the pressure that interest rate cuts may bring to the rupiah. Additionally, the central bank stated that it will maintain the direction of monetary policy to ensure inflation remains low and the exchange rate aligns with fundamentals. Some officials remain optimistic about Indonesia's economic prospects. They believe that interest rate cuts will help increase people's purchasing power and quote forecasts from international institutions that Indonesia's economy is expected to grow by 5.2% this year. However, some analysts worry that Bank Indonesia's move may be too risky. They believe that now is not the time for Indonesia, an emerging market, to loosen its monetary policy given the uncertainty about U.S. policy.
Tune in every Monday to Friday at 8 p.m. for Qingxiao View, the Business Bridge.